Hey, I'm Jason, and welcome to the Supply and Demand Daily, where I keep tabs on the economy so you don't have to. I hope you're having a good Monday. It is Monday, June 13th, 2022. We got a little bit of data out today. I'm going to talk about the bond market, and before I do any of that, I'm going to read a little snippet of a report, I guess maybe an article or a report, whatever you want to call it, from Argus, which collects a great deal of data about the energy trade. And this is about the U.S. shipping oil from its strategic petroleum reserve straight to Europe. So for a little bit of background, the President of the United States, ever since, I want to say early April, the President of the United States, Joseph R. Biden, has been making some gradual or rather huge releases from the strategic petroleum reserve. This is a supply of stored oil that is designed to basically keep the United States functioning in the event that we have some serious trade embargoes from other countries, like what happened in the 1970s, or some serious national security issues, like some kind of invasion, and we need an emergency supply of oil. Now what's going on is, in order to help the Europeans stop importing Russian oil, Joe Biden is releasing oil from the strategic petroleum reserve by the hundreds of millions of barrels in order to try to keep the price lower than it otherwise might be. But what I found out today, even though some of these articles are a little older, it was not anywhere near the front page. What I found out today is that a lot of that oil from the strategic petroleum reserve, I'm trying to figure out how much, I don't know exactly how much, is actually not going into the United States market, but it's being shipped directly from the SPR out to various European countries. So I'm just going to get into that, and I don't have any other analysis to offer because, again, this is news to me. I just want to share it and put it on your radar. So this is titled, this little mini report, or whatever you want to call it, U.S. SPR crude cargoes heading towards Europe. It was published on May 17th, 2022. Like I said, almost a month ago. It's news to me. It's probably news to you. Sour crude cargoes from the U.S. Strategic Petroleum Reserve, SPR, are traveling to Europe, helping supplement feedstocks for refiners seeking alternatives to Russian crude amid the Russian crude supply amid the conflict in Ukraine. The Total Energies chartered Aframax Sea Queen is expected to arrive in Rotterdam around 23rd May that is a very European way of writing a date, after departing from Beaumont, Texas earlier this month, according to vessel tracking data. Market participants expect the tanker to be carrying a cargo of Big Hill sour oil from the US SPR. Two 625,000 barrel parcels of Big Hill sour oil for delivery onto a vessel were awarded in the latest energy drawdown sale from the SPR at $1 to 1.5 barrel discounts to the Argus Mars volume weighted average, which I'm not entirely sure what that is, but it sounds like a benchmark for oil prices. Both cargoes were awarded to Atlantic, which is the trading arm of Total Energies. Meanwhile, the Aframax Sea Holly is expected to arrive in Trieste, Italy around the same time after loading at Freeport, Texas in late April. The tanker is chartered by Phillips 66 and is carrying Bryan Mound sour crude, according to Vortexa. Phillips 66 purchased 600,000 barrels of Bryan Mound sour for delivery onto a vessel at the Enterprise Seaway Terminal at Freeport in April or May as part of the first 30 million barrel emergency SPR release earlier this year. The company was awarded 4 250,000 barrel cargoes for delivery onto a vessel in the same auction, but destinations for the smaller parcels remains unclear. So what I'm gathering from this, just based on the numbers that we went through, is we have 625,000, we have 600,000, and then we have 4 shipments of 250,000 barrels, which is 2 million, a little over 2 million all told, and that means about 1/15 of the first 30 million barrel reserve is going straight to Europe, and that's just all that we know about. I don't know if there's any more. Like I said, I'm trying to find more information on this, but it's this is the most recent article I could find, and it's only from mid-May. So I'm not entirely sure the depth and scope of how much of this oil is getting shipped off to Europe. But if I find any more information out about it, you will obviously be the first to know. I'm going to very briefly go into inflation expectations now. So the New York Federal Reserve released some data on what consumers are expecting according to their survey. The inflation rate that consumers are expecting in 1 year and 3 years' time. What I have for you on this first chart is the green turquoisey sort of line here that is a little bit higher. That is the 1 year inflation expectation, or the inflation rate expected in 1 year's time. And then this purple line here is the actual rate of CPI inflation. Now, what you might notice here is that inflation expectations were extremely flat from the year 2014 all the way to 2020. And another thing to notice about this is that the movements, the rates of change at various times have been very well correlated with the changes in actual inflation. So it's almost like it's more of a reading of what consumers are looking at, not so much as what they're expecting, but the inflation that they're experiencing right now. And maybe consumers on average forecast that inflation is going to last for, maybe another year before it eventually goes away. Another thing that I thought was interesting is that it's almost permanently elevated above what the actual inflation line is, and what that tells me is that maybe the actual lived experience of inflation, at least as far as most consumers are concerned, is actually quite a bit higher than the recorded rate of inflation. So, for example, in the beginning part of the chart here, we have inflation expectations. Let's look at early 2013. We have inflation expectations of about 4% in a year's time, and we have CPI inflation of 1%. Maybe the differential between recorded inflation and the inflation that most consumers feel is actually between 2.5% and 3%. Just something to think about, because there are a lot of adjustments made to these CPI numbers that may make it quite unreflective of the reality of the types of, or the level of inflation that consumers tend to experience. Now, one exception to this general rule about the inflation expectations data having more of a reflection to today's inflation rather than expectations of tomorrow's inflation is what happened in basically April through June of 2020. While inflation was extremely subdued and not elevated at all, it went down quite a bit and was below 1%, below 1.5%, so pretty low by historical standards. The expected expectations or the expected inflation rate 1 year down the road actually went up quite a bit, considerably, and it kept going up, and it kept going up before the actual rate of inflation really started to go up in April of 2021. So I thought that was interesting too. And maybe a sign that, in this case, maybe because they saw what was going on with policy in May through June of 2020, maybe they saw what was going on with these things, and maybe they had a feeling about what inflation was going to do based on the legislation that was passed in the early days of the Biden administration with the American Rescue Plan checks, the $1,400 checks that were mailed out to everybody. Maybe consumers in this case actually forecasted the inflation before, the macroeconomic experts at the Federal Reserve or the Treasury Department or most economic departments in most universities across the United States did, which I would find very interesting if they did. It would be awesome if there were some supplemental questions as to, consumer, you say that inflation is going to go up a full 1%, for example, here in 2020 in the next year. Why do you think that? There are some manufacturing surveys that do ask special questions like that. They'll rotate a set of special questions each month that they send the survey out. I wasn't able to find any information like that for the New York Fed survey, but like I said, it would certainly be interesting if they did. This, by the way, is exactly what the Fed is talking about, what the chairman of the Federal Reserve is talking about when he says that the committee that sets interest rates, wants to create an environment where inflation expectations are well anchored at 2%. This is exactly what he means. So this 1 year out inflation rate, they would like to see that well anchored at the Fed's policy goal, their policy goal for inflation, which is to have a long run average inflation rate of 2%. So they believe that in order to get that the average consumer also needs to expect that inflation is going to be about 2%, because that's going to, the Federal Reserve, the policymaker people, they believe in a concept called the wage price spiral, and they believe in cost push inflation, which essentially means that what they want is for consumers and businesses to expect 2% inflation, because they will then make decisions based on that expectation, and then therefore inflation will be something like 2%. Now, what I think personally is that, and I've only been studying economics for 8 years or so, so take this with 6. So take this with a grain of salt. But what I think personally is that the FOMC, the Federal Reserve people who set the policy rates and everything, I think they need to go back and read their, the many books that were written by Milton Friedman. Of course, they didn't even listen to him when he was alive, but I think that they need to go back and read the writings of economist Milton Friedman and all of the empirical research that's been done on this very subject, and to get this idea that inflation expectations are going to determine reality. I don't think that there's a whole lot of validity to that, but it's how they set their policies. So that's why even though I don't think that this is the root of inflation, I look at these things anyway. So moving on, just another measure. So I mentioned earlier that we have 3-year inflation expectations as well as 1-year expectations. So I plotted those two against each other on this chart. And one thing that I'm realizing is that the axis is a little bit skewed to make these differences look quite small, but that's not necessarily important. I can still point out what I am intending to show. I found it really interesting that in the early days of the pandemic, so between April 2020 and April of 2021, is when most of the movement happened in the long run, in the 3-year rate of expected inflation. So you'll notice that this rate had basically hovered around 3%, the same as the 1-year expected rate of inflation, and then really jumped up in the latter part of 2020 going into 2021, and then has kind of hung around there for the better part of a year, going all the way back to May of 2021, and it went from, like I said, about 3%, all the way up to 4.75 to 5%, and it's been kind of hovering in that range ever since. And then there is an obvious uptrend that happened in the 1-year inflation rate. So if I go back to the chart that I was sharing earlier, the 1-year inflation rate has basically come into line. Expected inflation rate, right, is basically come into line with the current inflation rate. So that indicates that consumers, are thinking that whatever they're seeing now is going to be around for another 12 months or so. And then, the 3-year inflation expectations imply that they believe that between 1 and 5 years, it's gonna go back down. And why they think that is, again, not necessarily clear. Maybe they think that the central bank is going to be able to get control over it and do their job in terms of bringing about price stability, because that is the central bank's job. That's the Federal Reserve's job. Or maybe they just think it's going to die of natural causes. I'm not entirely sure. And then the bond market. Oh, yes. So a little while back, a few weeks back, I predicted, we were sitting here it was mid-May, and I predicted that this was going to be the top, this 3.18% in the 10-year Treasury yield specifically, which is this blue line. The orange line that I'm showing is the 5-year Treasury yield, the 5-year U.S. Treasury bond yield, and the blue line is the 2-year U.S. Treasury bond yield. I predicted that the top for the 10-year was going to be 3.18%, and I've been very, very wrong ever since Thursday of last week, when rumors first began to circulate that the inflation rate release by the Bureau of Labor Statistics was going to be a lot higher than expected, and lo and behold, it was. I am convinced that there are certain players in the market market. They get this information ahead of time, and then so they start to circulate these rumors. And I also believe that the chair of the Department of Labor, which is over the Bureau of Labor Statistics, which creates the Consumer Price Index and releases it, I also suspect that the reason that he was giving interviews and saying certain things about inflation being more persistent last week is because he knew, Mr. Marty Walsh was aware that that was going to be happening last Friday. I believe that was the 9th of the month. Not that that particular detail matters, but inflation rates, bond yields, that is the expected rate of return on these different types of bonds if held to maturity. It's not exactly that. So if you're a finance major, don't type me mean comments or anything. I do know the difference between interest rates, expected returns, and yields. It's all just very fuzzy if you're not in the industry. So roughly the rate of return that is paid on the bonds, we'll call it that, as well as another way of expressing the prices of the bonds themselves. And just to remind you of one thing, because this can be kind of confusing, whenever you're looking at a chart of bond yields, up actually means, where is it in a price chart, it would mean buying, right? If you're looking at stocks, then stock price goes up, that means buying. But if you're looking at bonds, it's basically the opposite. So you see an upward sloping line, that means that people are selling their bonds. And if you see a down sloping line, that means that people are buying the bonds. Okay. So we had this huge inflation surprise last week, and the rate of, and the yield on these different bonds went up between 35 and 50 basis points, which a basis point is 1/100%. So 50 basis points would be 0.5%, which is a really, really large move for a 2 or 3 day period. And so I definitely had some money in terms of my own investment portfolio staked on this being the top. And I learned, not to take really big short-term risks, because that was a nasty thing. That was a nasty thing to look at, and I quickly changed my strategy a little bit. But so I was definitely wrong about the bond market in this particular case, and it'll be interesting to see where these things go. The next auction for the 10-year Treasury bonds is going to be in a matter of weeks. I don't think there's one this week. I think there is one next week. So it may be that long until there is a correction that brings these yields back down below 3. But if they stay, a lot of participants in the market and analysts have been really watching this 3% level, and there's an expectation that if there are a lot of days that we close above 3%, because we've only had a couple at various times in the last 3 years really, there is an expectation that if yields remain very far above this 3% level, and they remain there for a great deal of time, then that really signals a new regime for the U.S. Treasury bond market and signals a new regime for interest rates. Interest rates have been historically low by all kinds of standards for the last 10, 14 years, basically, ever since the great financial crisis. And to see them rising this much, to see them stay elevated, would signal that maybe there's a different type of market environment on the way. So that is certainly interesting to see, and like I said, not good for my personal investments, but that's why we have rebalancing. Now, another thing to remember about the bond market, or about the general direction of interest rates and the behavior of interest rates, why do economists and people who like to analyze the economy, why do they look at these things? And it goes back about 100 years to a guy named Irving Fisher, who was an economist at Yale. And what he did was a great deal of empirical research on the relationship between risk-free interest rates, which he used bond yields just like these, to approximate. And he did a great deal of research on the relationship between those risk-free rates, those bond yields, and other types of economic outcomes, specifically the rate of inflation and the rate of economic growth. And the well-known equation that sort of comes out of that, even though he himself did not necessarily write it down in this way, I don't think in any of his writings he ever said the risk-free rate is equal to expected inflation and expected economic growth. But the way that his work has been interpreted and taught in macroeconomics textbooks is that the risk-free rate, the bond yields, like we were just looking at, is going to be, at least in the longer run tenors, in longer run maturity U.S. bonds or risk-free bonds. So government bonds, that's what we're talking about in general, is going to be some component made up of expected inflation and some component made up of the rate of expected economic growth. And so what it says, what's very interesting is that the bond yield, the risk-free rates, right? We'll stick with one terminology, right? We'll say bond yields, since that's what we're used to talking about. The bond yield is supposed to predict the inflation. The bond yield is supposed to predict the economic growth. So to see a situation in which there's a surprise to the upside in terms of the inflation rate that is announced, right? And we're not even talking about announced currently. These economic data releases that I go over, they're usually lagged by a month. So we're not even talking about current inflation. We're talking about inflation a month ago. And the announcement of that number actually propelled bond yields to increase this much. What that says about the economic relationship between bond yields and real economic outcomes, like inflation, which is the one that everybody has their eyes on, is that maybe that is either broken down or it's just kind of out of whack. Because if the bond market was going to indicate inflation, if it was going to indicate that inflation was going to last longer, then it really should have told us that maybe a year ago, but we didn't see that. We certainly didn't see the inflationary spikes of 8.5% reflected in the bond market because they have been below 3% for the better part of really most of the last 5 years, right? So that's why when people talk about the bond market lately, and when I talk about the bond market, there's just a lot of unknowns. It's a really interesting world to be living in, and that will pretty much wrap up the discussion for today. Oh yeah, I want to go over what's going to happen for the rest of the week because it is a Fed week. So the Federal Reserve Bank is going to make a decision about what to do with their policy rate. They will, if they believe that inflation has gotten really bad and that they need to really get a handle on it, that they really need to strangle it, then it's looking like they're going to increase their policy rate by about 75 basis points, which is 0.75% or 0.75%. And on the same day, we're going to get some more information about the housing market, specifically home builders. Tomorrow, we have a small business sentiment index coming out. We have the producer price index. We have the report, the oil market report from OPEC and OPEC Plus. On Thursday, we'll get jobless claims, same as we do every week, as well as housing starts and permits. And on Friday, we'll get industrial production. If you don't know what any of those things are, the good news is I keep tabs on the economy, so you don't have to. So I'm going to tell you what they are in case that happens to be a day when you are joining us, me, whatever, for these videos for the first time. So I do hope you enjoy the rest of your Monday. Thanks for joining me for Supply and Demand Daily. I hope you've enjoyed this kind of haphazard seeming presentation. Actually, maybe it wasn't that bad. I don't know. Feels a little, I don't know, having trouble finding words. But anyway, I'll be back on Tuesday with the Small Business Index, Producer Price Indices for May, and OPEC oil stuff. OPEC has been missing its production targets for the better part of about a year to 2 years now. So it'll be interesting to see how that went. They should be selling more oil and drilling more oil with the price as high as it is, but if that doesn't happen, it's kind of an indication that they don't have many reserves. So anyway, but we're going to go into all that kind of detail tomorrow. And but anyway, I wish you a wonderful rest of your Monday. Thanks again for joining me, and hope you have a good one. Thanks.